Australians would have heard plenty of reasons of why they should invest in private credit. At Livewire, we've interviewed tens of private credit managers over the last year alone. But what about the reasons why you wouldn't invest in the asset class? I'm Ali Selby, and today, for a completely different take on private credit, and so that you can understand the pitfalls and possibilities of investing in this asset class, we're joined by Josh Manning from Manning Asset Management. Thanks so much for joining us today, Josh. Really keen to have a completely different conversation about private credit today.
Thanks, Ali.
Let's get straight into it. What are some of the red flags investors should be aware of? Why shouldn't they be investing in private credit right now?
You look back to when we started in 2015, private credit was this unknown asset class, not prevalent in portfolios. You then went through a stage where people thought sort of all private credit was interchangeable. Construction finance was the same as asset-backed securities, or lending to lenders was the same as non-investment grade corporate lending. And they're the sort of the three buckets in Australia. You fast forward to today, everyone's talking about it. There's lots of glossy brochures around the benefits of investing in it. I think probably the main thing investors need to be thinking about in today's market is if you think about those three buckets, construction finance, non-investment grade corporate lending, asset-backed securities, where we specialise, you've seen this huge growth in managers in that construction finance space. At the same time that we're also seeing a very different Australian property market. We've had quite buoyant price growth, I think, over the last decade. And what that means is if you purchase a property and then you hold it for 12 months, typically you're selling it for more than what you bought it for. And that covers up a lot of sort of challenges in that particular loan, the sort of fundamentals of that loan. I think today that's not the case. I don't think you're going to have that same level of price appreciation. So the fundamentals, the exit, is even more important. At the same time, we're seeing this huge influx of capital and competition into that asset class. And I think if there's probably one takeaway, I think investors just really need to think about that and how strong these actual loan opportunities are and how clear is that exit.
Kind of sounds like you're calling for a crash in property markets. Do you feel like we should see prices cool off?
Yeah, I mean, don't ask a credit guy about the optimistic case. We're a risk person. We always think about the downside. I don't think property is going to drop 20, 30% and it's going to be this huge sort of macro events. I just think that the property prices probably won't appreciate, which has been an underlying dynamic that's propped up some of these transactions through time and potentially concealed some underlying issues. So I think just enhanced due diligence and thinking around these types of propositions is warranted for investors in construction finance and property related transactions, and certainly something we're thinking a lot about.
We're taught that all asset classes have cycles. Obviously, equities go through booms and busts. Bonds have been particularly volatile of late. Obviously, commodities go through a roller coaster of cycles. Do you feel like private credit has a cycle? I've heard varying opinions on this. Can people really avoid the downside?
Yeah, I think this sort of idea that private credit doesn't have a cycle is quite novel. I don't necessarily agree with that. I think it's different though. So typical asset class rides an economic cycle, boom to bust. It'll oscillate in a range with returns there. Credit, I think, is a bit different because it's really back when we started in 2015 where credit really started to grow in prevalence, awareness and adoption by investors. So it's almost had its own cycle of an asset class from, very early stages going through a huge growth curve at the moment where it's featuring in many more portfolios. And there will be at some stage a maturing of that cycle. And that characteristics of that maturing will be a more institutionalization of that asset class. And this is not dissimilar to what we've seen in US and European markets. And I think at that stage, there will be more divergence in those that prevail and those that don't succeed in that environment.
It's interesting that you say that because I literally spoke with a fund manager yesterday and she said there is no cycle in private credit. If there is a cycle in private credit, how close do you think we are to that cycle turning? If we are at this almost euphoria moment where there's lots of managers coming to the fore. There's a lot of excitement about the asset class. A lot of financial advisors are talking about allocating more and more, as are family offices. What's the outlook look like?
Yeah, so I think, so the first part, there's no cycle. Look at credit spreads in the public markets. They go up, they go down, like that is a cycle. The credit conditions in the external environment in terms of loan arrears and things like that, they have a cycle. So to say we're immune to that is, that would be amazing if that was true, but it's just not supported by data. In terms of where we are, I don't think necessarily an institutionalisation of the asset class will result in losses. So I don't see there's being this cataclysmic cliff that we're going to sort of drive off and there's going to be huge losses. I just think, we're seeing a huge increase in competition in the asset class, a lot of new managers, a lot of new players bidding for transactions. That will bid down credit spreads, that will bid down expected returns. And not everyone will be able to endure. In the infancy stage of this cycle, we saw credit spreads, being, you could see a deal priced at 600 over or 1200 over. It was just amazing, just the breadth of that. It's very much coming into a more tighter range at the moment. And people who relied on those very high spreads to survive with big upfront fees and things like that to propel their businesses, that's just going to be a lot harder. So I think we will see more managers come to the space. I think we'll see more managers not prevail, but I don't think that's necessarily bad for investors because I think the asset class in general is becoming more sophisticated, more adopted, more industry standards around how it needs to operate, and potentially some, harsher lenses around regulation, which once again is not necessarily a bad thing for those that do prevail.
It wouldn't be good though if an investor put their cash as savings with the manager and then they fall away. What are some red flags they can look out for?
There's probably a couple of red flags I think people need to be thinking about, particularly at this time in the market. So the big one at the moment is like what we call documentation risk. So that's transactions that have been lending that's been entered into where the documents aren't particularly robust. And that's all good and well in a buoyant market because the borrower is quite happy, an investor's getting a good rate of return. There's not a natural sort of tension there. When there's real headwinds and the borrower is unable to make those loan repayments, then they want to challenge those documents, and that is a risk. We don't like talking about fraud in financial services. I believe there's fraud in every asset class, in every part of financial services to a degree. It's not particularly prevalent, but you need to be thinking about that. I don't think it's hiding in our asset class, but you do need to keep an eye on it. What we call highly subordinated, so very, very leveraged exposures is another area where obviously you're taking a lot more risk and maybe not getting as rewarded as you used to. And I think that probably another key thing we're seeing a little bit is I think if investors even get a whiff of arrogance from managers they're dealing with, that to me is probably the most important telltale, because you look at the big banks, they are fantastic underwriters. I think they're some of the best lenders, if not the best lenders in our country. There's not one credit person in those banks who's arrogant. They're very humble people. They always realise that they can get bitten if they make the wrong decision. And I think there's something in that. So that's probably one of the key takeouts to really think about.
How about arrogance within lenders? In the pre-chat for this interview, you talked about some of the crazy things you've been told. What do you think are the biggest lies you've been told in recent years?
Yeah, so we as a business, we look at all the lenders across the Australian market and look at providing wholesale funding to them. So we speak to probably 15 to 20 lenders a month. And, there's a mix of people that give us, the bare bones, this is what's happening, these are the things in our book. There's others that put a marketing spin over. My favourite I get, too frequently is we don't have any problems in our book. You would love that to happen, but at the end of the day, even you make the best underwriting decision, facts can change, things can change, and that borrower is unable to make those repayments. And that's no fault of the lender, that's a reality. And you need to just work with those borrowers and find a way to get your capital back. So by saying we don't have any problems, it either means, well, they haven't been lending long enough, they're not thinking about the risks, or they're not necessarily being completely transparent. So that's probably the big thing. I also find this concept of we've never had a loss as sort of an interesting one, holding it up as that's the holy grail. If you look back through history, losses from lending and credit have been very lumpy. So there'll be periods where there's heightened losses. It's not this beautiful smooth line through time that oscillates marginally. So just because they haven't, it doesn't mean that they're particularly, immune from having that. And I think that self-confidence that we've never had a loss, therefore we won't, I think is probably a bit of a red flag as well. So that's probably the main sort of marketing spiel I get that you need to kind of look through.
Okay, Josh, you've completely convinced me on why I shouldn't invest in private credit right now. Why should I invest?
Yeah, well, like the way we look at it is if lending has been a very prevalent and sophisticated asset class in Australia for sort of circa 40 years. Over that time, there's been well understood risk management approaches, mechanisms, philosophies around how you manage transactions and manage lending to mitigate those risks. And I think if you can really pull the complete understanding around that sophistication in the asset class and embed that in your business and how you run money, I do think you can mitigate a lot of the risk and realise what these marketing pitches say, where it is a very consistent, inflation-adjusted real rate of return that's paid as income. And that's certainly been our history to date. Doesn't mean that we're immune from risks ourselves. We're constantly thinking about it. But I think if you get that bit right, then it is a great asset class. But I'm not necessarily convinced everyone is really learning from that history and applying that in today's context.
Well, thank you so much for your time today, Josh. It was awesome to talk to you all about private credit today. It was a very different interview. I really enjoyed it.
Thanks, Ali. Cheers.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.